Well, welcome to today's webinar. Really excited to have all of you here. This is the first one in the series that we will have for 2024. And what better way to start it off with talking about the Secure Act 2.0, which was passed at the end of 2022. And we'll also be covering changes to Social Security, to Medicare, also some updates to the tax brackets as well. So a lot of great information. I'd like to thank everyone for submitting your questions. You know, that is extremely helpful. It does help us shape the content that we're having. And then also, it allows us to know what's on your mind. When you submit those questions too, that gives us things to talk about on future podcast episodes. So some of the questions we weren't able to get to, and we will reach out to everybody post this, but also we will record our future podcast episodes, and we'll cover some of those questions as well. So be on the lookout for our next podcast where we cover some of the questions that came up during today's webinar. As I mentioned, we're going to talk about the Secure Act 2.0, but my name is Matt Wilson, and I am the President and Chief Investment Officer here at Keen Wealth Advisors. And, we focus on financial education. And this is something that is extremely important to us because we want people to be better consumers. We want them to understand their choices and to make decisions around that when we have those choices that we're faced with. So when you understand your options and you're able to make a better decision, I think everyone is in a better spot. So we do a lot of financial education via these webinars. We host live events. Mr. Keen also has his best selling book that's out there, Keen on Retirement, Engineering the Second Half of Your Life. He's on the second edition of that as well. And if you'd like a copy of that, of course, you can reach out to me. You can respond to any of the emails that we send out and ask for that copy. Other financial education, as I mentioned, is available on our website, keenwealthadvisors.com. If you navigate to the retirement resources page, you will see the page that has the podcast and the blog and also our webinar recordings. So you can find additional content there as well. And as I mentioned, Mr. Keen's best-selling book, Keen on Retirement, Engineering the Second Half of Your Life, Amazon bestseller. This is the second edition, has been updated for the new rules and regulations. So if you have a friend, family member, colleague that you'd like us to send this to, or if your copy is getting worn out and you'd like us to send you a new copy, please let us know. We are happy to do that at our expense. Again, just respond to any of the emails that we send out, either to myself, mwilson@keenwealthadvisors.com, or info@keenwealthadvisors.com. Let us know name and address, and we will get that book sent out to you. Okay, let's get on to today's webinar. What's new with Social Security and Medicare? Well, no major changes, but just, every year there's just slight tweaks to everything. Majority of those tweaks are just updates to numbers, to information. That it's already kind of pre-built in, so Congress doesn't have to make decisions on this. These are things that are just automatic. So every year we hear about the cost of living increase that comes out typically in the fall of the year before. There's also the earnings test, how much you can earn and still claim Social Security. We have how Social Security is taxed, and then of course Medicare premiums for those that are on Medicare, what the cost for 2024 will look like. Well, for 2024, yes, Social Security checks are going up. There's also additional increases to the earnings test, and also while you're working, FICA taxes. The FICA tax is how you pay for Social Security and Medicare, and the wage base that they base that on is adjusting. Well, let's talk about the cost of living increase for this year. For 2024, cost of living is 3.2%. And what I've got on this page is just if depending on what your benefit is, these are just kind of random amounts, what a 3.2% cost of living increase would mean from a dollar standpoint. Now, you would also receive notices from the Social Security Administration about what your benefit changes are. Typically, again, those are sent out in the late in the year prior, so late 2023, you would get that notice, kind of explain to you, here's what your new benefit is based on the cost of living increase. Here is going back to 1989, and this data is available on Social Security's website, so you can peruse that. You can see how the cost of living increases, what they've been over time. It's based on an index that the government publishes. They have to they have to follow the same thing. It's not like they get to decide. So they do have a formula that they look at. And the last several years, it's been significantly higher. Inflation has been higher, and cost of living increases within Social Security has been higher. It's coming down because inflation is coming down, but that's also coming off the the heels of some very low years. I mean, we had definitely some zeros post the great financial crisis of 2008, 2009. And you can see some sub 2% numbers in there as well. But then, inflation has been increasing here lately. 20-year average, 2.6%. And when the trustees for the Social Security program, they publish a report every year, and they project the cost of living increases in the future to be 2.4%. Now, no one knows, they have to base it on something. So they could use a higher number, lower number, but they're using a 2.4% future inflation calculation. 20-year average, again, as I've mentioned, has been 2.6. So they're not necessarily using something that's significantly different, but 2.4% compounded over time would make an impact on, some of the data that they're looking at. Now, let's talk about the earnings test. So the earnings test applies to people who are under their full retirement age. So that's what FRA stands for, full retirement age, and you're receiving your benefit. And what basically the Social Security Administration says, and IRS, is that you can only earn so much and claim Social Security if you're under your full retirement age. So for 2024, that number is $22,320. which is up just over $1,000 from 2023. So for every $2 that you earn over that and claim Social Security, you'll be penalized $1 in Social Security benefits. So for example, if you are on Social Security and you're 63 years old, because at 63, you would be under the full retirement age and you have earned income. This only applies to earned income. So it doesn't apply to IRA distributions. It doesn't apply to pensions. It doesn't apply to your spouse's or partner's income as well. So if you're married and you file a joint tax return, it only applies to your income, not theirs. So again, it's W-2 wages. It is self-employment income, those types of things that this is applied to. So if you earn $32,000 and you're claiming Social Security, well, you're $10,000 over the limit. You would have to pay back $5,000 of your Social Security benefit. The way they would find that out is on your tax return when you file your taxes, and they would notify you that you have earned too much and now you must pay that back. In a lot of cases, they would come up with I've seen this before, they come up with a payment plan. They don't just make you write a check and withhold future Social Security benefits until you've paid that back. There's a special calculation for the year you reach your full retirement age. So once you turn full retirement age, it doesn't matter. It's just those months prior to it, you're able to earn more, almost $60,000. And then the calculation is for every $3 over, $1 would be withheld. If this is something that you feel that applies to you or you're wanting to understand more about, please reach out to us. We're happy to kind of go through those calculations and how that all looks so that you understand what your choices are and what the potential penalties could be if that's even part of the calculation. The earnings cap. So this is the amount of income, earned income, that you pay FICA tax on. And this is specific to Social Security. There's two pieces to the FICA tax. There's Social Security and there's Medicare. Once once you reach $168,000, just over that, then your Social Security portion of the FICA tax stops. The Medicare portion goes on indefinitely. There is no cap to that. Now it's a much lower percentage tax, but there is no cap to that. And that is up from $160,000 in 2023. And then in 2022 is $147,000. So you can see over time, this has been slowly sneaking up, which, is part of the way that the government is helping pay for Social Security. They're slowly increasing this earnings cap. And the higher they raise the cap, the more income is subject to Social Security. And this is on an individual basis too. This is not on a joint file or anything like that. This is just per person on a tax return. As I mentioned, the Social Security portion is a portion of the FICA tax, so that's 6.2%. Your employer pays the other 6.2%, so 12.4% of your income is going into Social Security. And then on Medicare, that amount is much less, but there's no cap. It's 1.45. Your employer pays the other half, 2.9%. If you're self-employed, you have to pay both sides of it. So it is a, kind of a penalty, self-employment penalty, as sometimes it's referred to. Now let's talk about how Social Security is taxed. There is a formula that is unique to Social Security income that determines how much of your benefits count as income. So these aren't tax rates. These are just how much of it actually shows up on your tax return as taxable income. So if you're married, filing jointly, and if your provisional income, which is all of your adjusted gross income, not including your Social Security, plus 1/2 of your Social Security benefit, plus your tax exempt interest. So if you have any municipal bonds that are paying tax exempt interest, they add that back. Now you don't pay federal tax on that, but for this calculation, it does apply. If that dollar amount adds up to under $32,000, then none of your Social Security counts as income. So you're receiving it 100% tax-free. As your provisional income, as this calculation increases, so from $32,000 to $44,000, then half of it counts as income. So half of your Social Security shows up as taxable income and then flows through the tax brackets. And then once provisional income gets over $44,000, then it's 85% of it counts as income. You receive 15% of it tax-free. You can see here the other filing statuses. Single, it's not quite half. Actually, it's a little bit more than half. So they give you a little bit more leeway on the provisional income calculation. And then if you're married filing separately, then anything over $0, you have the max Social Security kind of income calculation. So you get 15% of it tax-free, 85% of it counts as income. Now let's talk about Medicare premiums as well. So some changes to that in 2024. Medicare premiums went up to $174.70. And then also some people may pay more due to IRMA, which stands for the Income Related Monthly Adjustment Amount. Now there's this hold harmless provision, will not apply this year, but basically it says that if the Social Security cost of living increase does not cover the increase in the Part B premium, then they won't, the government won't take more than what that increase is. So they will limit the amount of the increase in Medicare if it does not cover the dollar amount increase in Social Security. And the reason it doesn't apply is because the Medicare premium went up much less than the Social Security cost of living increase from a dollar amount standpoint. This is not a percentage increase, it's a dollar amount that they look at on this. So here, let's talk about IRMA. This does apply to some folks, especially folks that we're working with and we're doing some tax planning and forward projections on RMDs and future tax brackets too. We're looking at what your tax liability is today, what it can be in the future, and how do we minimize your lifetime tax? And sometimes those solutions, or at least recommendations, do incur some IRMA surcharges because it's much cheaper to pay that, over maybe a less shorter time period than it is for the future when your RMDs are significantly higher. The thresholds for IRMA this year are $103,000 if you're single, $206,000 if you're married filing jointly. And the way they look at that is that dollar amount isn't, again, it's its own calculation. It is what's called modified adjusted gross income, which is your adjusted gross income plus tax exempt interest. So similar to provisional in that sense. And it looks at your tax return from 2 years prior. So your 2024 Medicare premium, if you're subject to the IRMA surcharge, is based on your 2022 tax return. And that's how this has been for many years, and I don't see them changing that anytime soon, but that's how they calculate it. And if your income changes due to a life-changing event such as retirement, you can file an appeal. So if you got a letter, let's say you worked in 2022, you were still employed, you were working, you were earning a good amount of income, you retired in 2023, you're Medicare age, so you signed up for Medicare, and at the end of 2023, you got your letter from Social Security indicating what your Social Security payment was if you were on Social Security, but you're on Medicare. And your Medicare premium for 2024, they're going to tell you, is based on your 2022 tax return, and that might be over this threshold. Well, you can file an appeal to to the government and basically tell them that, hey, I was still working then, my income is less now, and I will be under the threshold, and they will not charge the IRMA surcharge to you, and you will go back to the base Medicare premium. Now, if your income, and this is only if your income is less than these brackets. So if your income actually does happen to be higher than what you thought, and you were subject to one of the IRMA surcharges, they will find out on your tax return when you do file your taxes and apply the surcharges then. These brackets also are automatically adjusted for inflation on an annual basis. So, unless Congress wants to change, something significant to this, there's nothing they need to do to just kind of increase these brackets on a regular basis. Here you can see the base, this very first row, this is just base premium, $170.70 for Part B. That's what everyone pays. Part D, that's going to be different for everybody based on your prescription drug plan that you choose, but there's no surcharge if your income's under these thresholds. Now, as your income hits those thresholds, well, then you can see the additional surcharges here. And this is per person. So if you're single, it applies to you. If you're married or filing a joint tax return, it applies to both of you if you're both on Medicare. You can see how those increase as your income increases. And one of the things too to be aware of is this is a cliff. So $1 into this next bracket triggers the surcharge. So it's just something to be aware of. If you're close to one of these brackets and you make a decision to accelerate some income, you might be actually paying a lot more tax on that additional income if you're not aware where these thresholds are. Our planning software that we use from a tax planning standpoint, we're constantly looking at these brackets and how they fit into, everyone's individual plan when it comes to, what we're looking at over their lifetime when it comes to their tax rate, lifetime tax rate. One thing too to be aware of is this only applies for 1 year. So for example, in 2022, your income was higher, as I mentioned. And let's say you were retired then. So now you're still subject to the surcharge in 2024. Well, if your income in 2023 went down and you're below the threshold, then in 2025, you'll be back to the base premium. So this is not a permanent increase. This is a year-by-year calculation based on income from 2 years prior. As I mentioned to the tax brackets, there's, again, cost of living increases to these on an annual basis. I've got these listed out here. There's 7 brackets, and these changed in 2017 with the passing of the Tax Cuts and Jobs Act. There's still 7 brackets, but the percentage tax did go down from that passing of the Tax Cuts and Jobs Act. That is set to sunset in 2025. So in 2026, if that is not renewed or no new tax plan is passed by Congress, well, then we will see tax brackets go up at that point. But you can kind of see where as your income increases, the percentage tax you pay on that additional income also increases. So if you're in the 22% bracket, it doesn't apply to all of your income. It just applies to the income that's within these thresholds. Capital gains too has a different calculation. If your income is in basically the first 2 brackets, the 10 and 12% bracket, then your capital gains are taxed at 0% up to the point you reach the top of that bracket. So, for example, if you have $50,000 in taxable income and you're married, well, you can have another $44,000 in capital gains that will be taxed at 0%. So something to be aware of too, because we find a lot of people don't know that. They don't realize that, well, I could have been taking capital gains at no tax versus thinking it was all at 15%, because that is, the common way to think about capital gains is they're taxed at a 15% rate. That is true once you hit a certain income amount. And then, of course, when your income gets to an even higher amount, they do tack on a higher tax rate for those additional capital gains. Now let's go over some of the Secure Act 2.0. So there are some significant changes that do impact people that are listening to this webinar, those that are at or near retirement or in retirement. So, I like to cover these on a routine basis, because again, these are some things that, like, they were the same for years, and all of a sudden we've had several changes in the last couple of years. So Secure Act 1.0, which was passed at the end of 2019, and then COVID hit, so it kind of got buried a little bit because we had a lot of things happening with COVID that took people's attention away from it, but increased the RMD age. So that's the age that you're forced to take distributions from your retirement accounts if you aren't already. And again, there's a calculation for that, how much you have to take based on the prior year's balance and whether you're married and if your spouse is more than 10 years younger or not. There's a formula around all that. We calculate that for all our clients, make sure this is taken care of. But they increased it from 70.5 to 72 with the passing of the Secure Act 1.0. And then now with the passing of the Secure Act 2.0, which was passed at the end of 2022, RMD ages are increasing to 73 and to 75. So you can kind of, now that we're in 2024, RMD age is 73. And you can push back your first RMD. That has not changed. That has been the way for quite some time. Your first RMD, you have up until April 1st of the year after you turn 73 to take that. Now, you would also have to take an RMD for that year. So you would have 2 required distributions that year, but it does allow you some flexibility if maybe you're still working, you have a large taxable event, and you want to just push future taxable income into a future year. That's definitely a possibility. Starting in 2033, RMD age will increase to age 75. And then another kind of component to this is that if you're still working and you have access and you're contributing to your 401k, well, there's no required minimum distribution on that account at your current employer. If you have IRA balances outside of that employer, then you're subject to required minimum distributions if you're, at RMD age. But they're not forcing out Roth 401ks now. Prior to that, they were, if you had a Roth 401k and you separated service, but you left the money in there, you would have to be forced to take an RMD if you did not roll that money over into a Roth IRA. Roth IRAs do not have any required minimum distributions on it. So that's one thing that to be aware of if you're utilizing a Roth IRA. So here's how to look at it. If you're born, your birth year's 1951 to 1959, RMD age is age 73. If you're born in 1960 or later, RMD age is now 75. So kind of how that all works. There's no changes to qualified charitable distribution, so those can all continue to be made at age 70 and a half. Now you must reach age 70 and a half to utilize that. And that is a strategy to where you write a check or you take a distribution out of your IRA and you send it directly to a charity. That counts towards, any required minimum distribution. Now, if you're 70 and a half, you don't have one. If you were 73 and you had to take money out, well, that amount that you send to a charity does count towards that. And it also does not show up as taxable income. So you get a benefit there if you're donating money to charity. And you're 70 and a half or older, one thing to look at is a QCD strategy. If you're already receiving income, well, a lot of times you're covering the RMD. And again, for our clients, we review that annually, make sure everyone is distributing the required minimum distribution, not getting in trouble with the IRS as well. And, delaying your distributions out of your IRA isn't always the best strategy. And the reason I say that is because we look at someone's lifetime tax liability. And, one of the objectives is, well, if someone's in retirement, they could be in retirement for 30 plus years. And based on current tax law, we can project out, based on certain assumptions related to investment earnings and everything else, like, okay, here's what future RMDs could look like. And again, it's a calculation based on the inputs that we have. So it's not going to be, exact, because we don't know what future rates of returns are, and we don't know what future tax brackets are, but we know what current tax brackets are, and we can use current tax law. And then we can look at, okay, well, your lifetime tax liability is this. If we utilize some tax saving strategies like Roth conversions and QCDs and, donor advised funds and kind of all these other strategies to minimize tax liability, what impact does that have on your future tax liability? And we can show that to you. Here's how much dollars could be saved by utilizing these strategies. So big proponents of that. By delaying your RMD, you potentially could just be pushing money out into the future. So maybe not having a lot of current taxable income, but having a large future tax bill for many years as well, because you'll be forced to take that out once you hit that required minimum distribution age for the rest of your life. So let's talk about some Roth accounts. There are some changes to these. This was effective in 2023. There are now options for simple and SEP accounts where you can contribute to the Roth portion of that. So you don't get a tax deduction in the current year, but it grows tax free. So that's the benefit of the Roth. And then employer contributions are now eligible for Roth treatment. So if your employer plan adopts this, so there's part of that has to happen. And for a lot of plans, they we'll look at this, especially the big employers, but it will be included in your gross income. So prior to the passing of Secure Act 2.0, all employer contributions were just put in the pre-tax account. You didn't have a choice. Now you can choose, again, if your plan adopts this provision, to elect to have it go into the Roth account, and it would be taxable to you. So you will have a tax bill related to that. But if you prefer that, is definitely an option now. There's no RMDs for Roth 401k. So if you're utilizing the Roth 401k and you left the money in the 401k account, there's not forcing any requirement of distributions like they were prior to this. The other kind of big change that is kicking in this year, and I have a little bit more data in a few slides here that I'll cover this, but for catch-up contributions. So once you hit a certain age, once you hit age 70, or excuse me, age 50, and you're still working, you can utilize the catch-up contribution within your employer plan. So, you know, there's a maximum that everyone can put in every year, but if you're over age 50, you can put in an additional amount. They call that a catch-up contribution. If you earn over $145,000 in the prior year, all of your catch-up contributions will go into the Roth account. So I have the word Rothified in here. So you don't have a choice. It's going to go into the Roth 401k and it's going to be taxable income to you. So that's how that's going to work in 2024. So for all of you that are utilizing catch-up contributions and your income was over 145,000 in 2023, then your catch-up contributions will go into that Roth account and be taxable to you, you know, come tax time. 529 accounts, there's also some significant changes to these now. So this is beginning this year. We have received a lot of questions on 529 accounts. The government, Congress, we don't have exact visibility or clarity onto how this specifically is going to work, but we do believe this will be given to us shortly, you know, in terms of just like all these kind of specific things related to how, you know, how these distributions from the 529 accounts work and everything else. But what they're allowing, this was passed at the end of 2022 with the passing of Secure Act 2.0, is you can now move money from a 529 account to a Roth IRA. The way this works is though the Roth IRA must be the same name as the beneficiary. So when you have a 529 account, you name a beneficiary. You know, a lot of times that's a child. It could be yourself. You can name yourself as the beneficiary, but you also have to have earned income equal to the amount that is transferred every year. And there's a limit to how much you can transfer each year. And then there's a limit on a maximum amount that you can transfer over time. And what this is in response to is there are some people that utilize 529 accounts. You know, they contributed to them, and what that account is it's a way to save for. And when they first came out, it was a way to save for college, and you would get a small state tax deduction, if any. I mean, it was not really about the current tax deduction, but as long as the money was used for college, you could take tax-free distribution, so not pay any tax on the gains on the investments and use it for college. They have expanded that. You can use that now basically for any education. And so it's not just limited to college. So you have some more flexibility with that, with some law changes over the last several years. But there were situations where people saved for college and maybe they got a scholarship, or they didn't go to a college that cost as much as, you know, they saved. So there's excess balances in these accounts. And if you don't use them for, you know, for education expenses, well, then you get taxed on the gain if you pull a distribution out and penalized on the gain 10%. So it's kind of really restrictive if you don't use it for education. So to free up that money, Secure Act 2.0 came up with this, okay, we're going to allow people with excess balances, you know, to move money out. Additional rules related to that. So you have to have had the account opened for at least 15 years. And, you know, I interpret that as opened and, you know, have funds in it, not just opened with zero balance. And then any contributions to the 529 plan within the last 5 years are ineligible to be moved. So there's some tracking that the 529 custodian will be doing in this. If you're making regular contributions. And then, as I mentioned, you have to have earned income, the beneficiary does, to make these, because what they're doing is they're basically looking at this and saying, we're allowing you to take money out of the 529 and make a Roth contribution. Well, a contribution, any IRA contribution, Roth contribution, you have to have earned income to do that. And there's a limit to how much you can put in. There's an annual limit that does adjust with cost of living. But if you are already contributing to the regular IRA or Roth IRA, that might reduce what you're able to transfer out of the 529. And then the lifetime transfer is $35,000. So again, a lot of restrictions on how to contribute to a Roth IRA from the 529. As we receive more clarity on this, we will continue to keep you updated on, the specifics. You also can withdraw up to $10,000 from any 529 account to pay for any student loans. So, as I mentioned, you can change beneficiaries. So if you have, one child that, maybe you had a couple of 529s, one for each child, you had 2 kids, and maybe one went to a more expensive school and the 529 did not cover all the expenses. The other child, either maybe they didn't go to college, they went to a trade school, which actually it does allow some expenses now for that to be paid by the 529, or they did something else and they have money in their 529. Well, you can change the beneficiary if you so choose to help pay off student loans. Some rule changes too around surviving spouse beneficiaries. So if you pass away and your spouse is your primary beneficiary, there are some specific things that they are eligible to do that not all beneficiaries are. So like children aren't necessarily able to do this, but surviving spouses are. So when a surviving spouse inherits an IRA, they can, one, treat it as their own, so just transfer it into their existing IRA. If they don't have an existing IRA, they can just basically change the name. So that's number 2, just it becomes their own. Or this third option is they can remain the beneficiary of the IRA with special treatment. That would be setting up what's called an inherited IRA. And this is a planning situation to where someone is under age 59 and a half. Because if you're under age 59 and a half, you cannot take distributions from an IRA without incurring a 10% penalty. There's ways around that if you elect to utilize the 72T strategy. But if you have an inherited IRA, you have to take distributions out of that account on a regular basis. But so they don't subject that to a 10% penalty. So a surviving spouse who inherits an IRA and they're under age 59 and a half, they're able to, still have access to the money with these rules around taking distributions. And then the special treatment is once they reach 59 and a half, they can then convert it back to a traditional IRA, which is unique. So surviving spouse, they provide a lot of flexibility when it comes to these IRAs to make sure they're not incurring, I would say, any additional penalties or taxes just because their spouse passed away. The other piece of this is that starting in 2024, the surviving spouse, so if the deceased spouse was younger, so let's say surviving spouse is 75, deceased spouse is 65, their surviving spouse can delay required minimum distributions until the deceased spouse would have to start taking them. So that is a new piece to this that is beginning this year in 2024. So it is something that we'll review on a regular basis when people do come across these situations. I mean, it is something that we're very aware with, and there's a lot of emotion around these situations when someone passes away. So we want to make sure too that we're taking the right making the right financial decisions when these decisions are having to be made. So there's, all these kind of rules around that when you calculate the RMDs, and the 10-year rule that would otherwise apply, because surviving spouses, again, have special situations when it comes to inheriting IRAs and how that works. The catch-up contribution, as I mentioned, a little bit different now. So starting in 2024, the contribution limit remains, it's been at this $1,000 amount for more than 15 years. They'll be now indexed for inflation, so that's kind of a new thing. And then again, as I mentioned, if you made over $145,000, plan to, or you did in the prior year, your catch-up contribution will now be deposited into the Roth account, making it taxable to you in the year that happens. Now, in 2025, they are changing the formulas slightly to allow even larger contributions to be made for folks that are in their early 60s and still working and still making contributions to the retirement account. There's, again, some formulas kind of related to this, and I'll show you on the next page kind of a chart that I think helps explain this in a little bit better fashion. So if you're under age 50, there's no catch-up contribution. You can just make the normal 401k contribution from age 59, or excuse me, from age 50 to 59. Your catch-up contribution in 2024 is an additional $7,500. Then starting in 2025, and this actually, this whole thing starts in 2025, from 50 plus in 2024, it's an extra $7,500. Starting in 2025, you have now these age brackets to where they'll allow you to put in the greater of $10,000 or 150% of $7,500, which is like $11,250, I believe, is the number for those years. You can have an enhanced catch-up contribution, and then at age 64, it goes back down to the standard catch-up contribution. It seems like with so many things that Congress and the IRS and everyone does, it is never as simple as it should be. It's definitely something that is more complicated. The QCDs, as I mentioned, you can still take those distributions at age 70 and a half. That amount has a maximum of $100,000 on an annual basis, and that is per person. So, if you, again, a married couple, each have IRAs, each over 70 and a half, they can each make a qualified charitable distribution of up to $100,000 each year. Starting this year, they will begin indexing this for inflation because it's been $100,000 for many years. So now this will have a cost of living increase added to it on an annual basis. There's also some additional flexibility related to long-term care insurance. So if you are a participant in a retirement plan, you can take distributions from your company plan to pay for long-term care insurance. It's up to $2,500, and that kicks in at basically end of 2025. So, again, not something that is immediate, but coming down the road. And if this is something that applies to you, we'll definitely share, more thoughts on how to think about that and how to pay for that and make those distributions. 72T, so this is a way to avoid the 10% penalty. And the way this works is if you are, let's say you're age 50 or age 55 and you want to retire, and you have money inside your retirement plan, you have money inside an IRA, but it's all subject to a 10% penalty if you're under age 59 and a half. Well, 72T is, it's basically the section of the tax code. That's what that 72 brackets T stands for, is where they allow you to take equal distributions. They call it equal periodic payments based on, there's a formula with a interest rate calculation. It's all specified by the government how this works. But if you take equal distributions every year until you either have done this for 5 years or until you're 59 and a half, whichever is longer, then they don't trigger the 10% penalty. Something we're very familiar with. We're able to execute on these. So again, if you're thinking about this, come talk to us and we'll show you exactly how this works and how to set this up, because there's ways to set this up to provide you additional flexibility as well to kind of minimize any problems associated with this. But the rules that they've basically come up with is saying in 2024, if you have rollovers or transfers in and out of your IRA, that's not going to be considered a modification to your 72T payments, as long as you're distributing the same dollar amount. This is more of a clarification. I do think people were probably having some of this happen from time to time, because you may have money at a custodian that you're not happy with, and you want to transfer it somewhere else. And, for the government to say that you can't would be, I think a little bit restrictive and not necessarily in the spirit of what they're trying to do. Really, all they want you to do is just make sure you take the same dollar amount every year. So as long as you can prove that with all your 1099s and show that, hey, I didn't modify this from a distribution standpoint, you're not going to have any problems when it comes to this. They also have changed the penalty for missed RMDs. So the prior penalty, if you forgot to take your RMD, was 50%, a significant amount. That's now reduced to 25%. And if you happen to catch it in what they consider a correction window, and my interpretation is that if you figure out or realize you did not take your RMD before the government or the IRS tells you that, so eventually they're going to tell you. They're going to say, hey, we don't see that you've taken any distributions out of this IRA. You're going to owe us this penalty plus interest. Well, if you happen to catch it prior to them telling you this, then I think you're in that correction window. That's my interpretation of that. And there's a much smaller penalty if you're able to identify that and correct it. And then lastly, we did get some questions too on, okay, how does the next generation, my children, inherit my IRA? I've got an IRA balance. I'm not going to spend the money. Okay, I understand the spousal rules, but how do the kids inherit the money? Well, there is the death of the stretch IRA, as this says. And your kids can inherit the IRA still, but they have to take distributions. There's kind of some rules around, do they have to take them every year or not? But the overarching kind of theme is the IRA that they inherit has to be exhausted by the end of the 10th year after they inherit it. So they have 10 years basically to take all the money out, and that applies to traditional IRAs and to Roth IRAs. And traditional IRAs would be taxable to them. Roth IRAs are not taxable, but it gets it out of the Roth account, so it's not growing tax-free anymore. Once you take the money out of the Roth, you can reinvest it in a non-Roth account, but now it's subject to capital gains tax, dividend income, interest income, those are all taxed on an annual basis. When it's in the Roth wrapper, it's not. So that is the rule around inheriting IRAs. If you were at your RMD age and you were taking RMD distributions, then your children would have to continue those distributions on an annual basis. So that is a calculation that, early on when this rule changed, this was part of Secure Act 1.0. There was it was not very clear, and the IRS government came out and clarified that RMDs do have to continue if you're at that age, and you must, or if the deceased person was taking RMDs, the inherited IRA for the non-spouse beneficiaries would have to continue those. There's also some exemptions to this. So if you have a beneficiary that's considered disabled or chronically ill, if they are not more than 10 years younger, so maybe you left this to a friend or a a sibling and they weren't more than 10 years younger, then they're not subject to the 10-year rule. And then minor children are also not subject to the 10-year rule. They are able to, stretch the IRA under the old rules, but then the 10-year clock starts once they reach the age of majority. So now I know I talked a lot. There was so much information in this webinar. And again, I appreciate all the questions that everyone sent in throughout the webinar. We're at the top of the hour here, so we will, we will get to everyone's questions. As I mentioned, future podcast episodes, we'll also reach out to you on an individual basis too, if there's anything specific to you that we do need to cover. But hopefully, people walk away from this, they learn something, but also realize that tax planning is significant when it comes to someone's retirement plan. It's not just about processing tax returns. It's about, how do I minimize my lifetime tax liability? I have this IRA balance and I've got this, these accounts, and I want to make sure that I'm taking distributions from these accounts in an efficient way and not paying unnecessary taxes. And understanding how that looks for you and for your family is, it's unique to you. It's different for everybody. And that's what we do. So the clients on this webinar, you're familiar with our process. You know how we sit down, at least on an annual basis, where we're going through this plan. We're talking about your tax liabilities, your tax plan, your income plan, all of these different things to make sure that we're minimizing, your lifetime tax liability. And if you're not a client, that's our offer to you. If you're on this webinar, we've got a team of CFPs here that are willing and able to sit down with you and go through this with you. There's no cost to do that. It's just a way for us to see if there's a fit for us to work together, and we will show you how that how that all works when we have our meeting. So again, thank you all for joining today's webinar. Check out previous webinars at keenwealthadvisors.com under the retirement resources page. You can also, again, see the podcast and blog posts there. And then lastly, if you'd like a copy of Mr. Keen's best-selling book, Keen on Retirement, Engineering the Second Half of Life, let me get that in the screen here. Send me an email, mwilson@keenwealthadvisors.com, and I will get that sent out to you. Again, thank you and enjoy the rest of your day.